All right. Well, welcome everyone. I assume you can hear me. I'm going to talk unless someone tells me to stop because they can't hear me. Um, we're almost here at the end of October. So welcome to October's webinar. We're going to go through really market updates today and then some questions and answers. Thank you to those of you that got the email and clicked through and sent your answers in advance. We'll answer a couple of those, and then obviously at the end as we're going through it, anyone that does have questions that they want to kind of go through, look at, so that we can give you some updates as things have changed, or you got questions on the service, then we'll go through those. So with that, I am going to go ahead and hand straight over to Tony, Director of Research, who's going to kind of walk us through some of the market updates here and give you where we are today. So Tony, the floor is now yours.
All right, thank you, Tom. The Fed cut rates a quarter point today, which was widely expected. So ultimately, after a brief short sell-off, the market rebounded and ended essentially flat. So the sell-off was due to Powell saying that the December rate cuts were far from a foregone conclusion, which kind of spooked the markets a little bit. So anyways, we'll be keeping an eye on that. Let's start off by where all of our indicators are. They all are currently on buy signals, including calendar effects in the market as well. So we pretty much have green across the board with all of our risk management indicators. Next, please. And this is a exercise I've been doing this year where I take all 5 of our main equity indicators and then I highlight the models that feature each one of those equity indicators and assign a 20% weight to each one of them, as shown in the slide. And we get some pretty interesting results when we do this. Next one, please. All right, so over the 25-year time period that we test over, we see a solid improvement in CAGR. And what's most important, at least from my chair, being primarily a risk manager, is we get to see quite a reduction in maximum drawdown down to 19% versus negative 55 for straight SPY SP 500. And as we all know, the clients generally handle volatility somewhat okay, but once we start seeing drawdowns greater than 20%, that's kind of the magic number that I've noticed over the years, that the phones start to ring in an unpleasant way. So next one, please. The equity line, again, that's smooth up and to the right. Much of the outperformance you can see occurred in the first 10 years of testing up till about 2010. Since then, we've seen a very kind of concentrated market, as especially lately, as things rotate into AI-driven stocks and a narrow market into the NASDAQ 100. But still, we see reduced volatility, and we still continue to see, even though that spread is narrowing, what we're really doing again is we're just trying to provide that smooth, survivable journey for clients. Next one. So what's been working so far this year? Gold, obviously, everybody is talking about it. Actually, everybody started talking about it probably at the beginning of the month. And we have seen a sell-off in gold recently over the last couple of weeks. I don't consider that to be the end of the run. I think there's a lot left. But once you start hearing people at the grocery store talking about gold or grandma at the dinner table, you know that it's probably due for at least some sort of correction, which we're seeing. So still, as of Monday, this was our risk managed gold model was up 55.9%. So pretty solid return there. Next, please. Next best performer was long short. This one, many of you may not be able to participate in since it does have a short component. But still, we're seeing a 32.3% year-to-date return, which is still almost double the benchmark of SPY. Next, please. All right, and then third, we have Harmony 4. This one also can use leverage both to the upside and downside. This one is also showing solid performance. So again, we have a lot of models, we have a lot of blends, and it's definitely worth your time to dig into them and see all of our options to see which ones fit best with your style and that of your clients. Next, please. So where are we now? The kind of our star path ranking table is a really quick way to see where these certain segments of the market are headed and where they're at currently. Technology at the top, that's been the theme all year. One thing here that's a good sign is that we're showing small caps in the number 4 position. And while many of the big techs have much of their revenue can focus on international markets, small caps are almost all domestic. So when we see solid outperformance by IWM and small caps, that gives a little bit of further support that the economy is perhaps a little bit more stable than the headlines lead us to believe. Next. Here's another way to look at risk, whether we're in a risk on versus risk off environment, is simply compare consumer cyclicals versus consumer staples. As you can see, we had solid outperformance going into the year, and which turned around once the tariff tantrum started to hit in late February through April. And we're seeing consumer cyclicals once again lead the market or lead staples. So this bodes well into the end of the year. And then again, obviously, none of this is, that we're predicting. All we're doing is we're saying whether signs are positive or negative. So we got another positive one here. Next one, please. There's the gold that we talked about earlier. Had that breakout from the quadruple top and a nice run that we participated in. And we're seeing that support. It seems to be getting support around a little bit below the 21-day moving average, the monthly moving average, and well above the 50-day. So it's possible it will pull back as far as the 50. I would think, I would estimate that any sell-off that severe would be bought. But we'll continue to just follow the trends, follow our models, follow the indicators as always. Next, please. Checking the credit markets, there's been a lot of talk. If you watch any of the major financial news that private equity, there may be some Jamie Dimon at JP Morgan says when you see one cockroach, there's probably more. A lot of the regional banks are starting to get hit with some of the turns out that some of their holdings in private equity might not be as profitable or robust as they thought they were when they bought it. Still, that seems to be contained so far to the handful of regionals that have reported that in their earnings. The headline numbers still so far they look okay. Credit markets remain quiet with bankruptcy filings still declining. So we'll take that at its word. Next, please. VIX, looking at volatility index of the S&P 500. This is also subdued at right around 16. We really don't get worried until this is above 30. And this is also another risk measure that's remaining quiet right now. Next, please. And I look again at credit markets. This is the additional yield that investors are demanding to take higher yield, aka junk bonds, over a comparable maturity U.S. Treasury. And as long as it's less than 3%, we're in okay territory. We're sitting at around 2.9. So still, again, another sign that under the hood that things don't look too bad in the markets. Next, please. The S&P 500, it ended today pretty much flat. It's still quite a bit above the 21-day. As you can see there, the violet line, it's found support there 6 or 7 times so far this year, or actually since May. And again, we're showing above long-term, medium-term, and short-term moving averages. So the trend continues to be our friend. Next, please. And we're coming into some seasonally favorable periods. This is since 1950, monthly returns there at the bottom. November actually has the highest average monthly return of 1.9%, and December at 1.4% is tied with April. So hopefully we're we're going to get through a little bit more time here, and we'll get into more of the Thanksgiving and Santa Claus rallies, and hopefully get a strong finish to the year. Next, please. So where are we at today? The rally remains broad-based. It's bullish. We're seeing buying and support above the short-term, intermediate-term, and long-term moving averages. Seasonality is positive. All of our trend indicators are positive. Risk indicators remain subdued, both for the market and for credit markets. And all of this is bullish for right now, but as always, can change on a dime. And we'll continue to follow the indicators and their signals as disciplined investors. That's all I got, Tommy.
Excellent. Thank you, Tony. All right, well, we're going to, from there, jump straight into a time of open forum, questions and answers, if you've got them. So, as always, please either raise your hand or type in a question. We would love to hear from you and answer some questions live. There is a couple that came through, so I'm going to answer those here. The first question was, what's going on with the Sherman Risk Life tickers? Are they being updated? So just to clarify, obviously, nitrogen is what you might hear us call it. Nitrogen, formerly Riskalyze. We have an exclusive partnership with them where all of our models, as they stand, are all risk scored by nitrogen on a quarterly basis. I think the question was in relation to, was there some kind of lag in update? Yes, the answer, there was some kind of lag that was caught and fixed. So as you see them when you go into the portfolio toolkit, or whether you're on the model detail pages, those risk scores that you see on our models are live, are working, are updated quarterly, and they're active. So whether or not you use them just to kind of get an idea for the risk as they stand, or if you're using them because you have a nitrogen account and you're actually taking clients through the risk score profile, those are live and active and working. So great question, and yes, they're still active. Second question that we got that came through was, can you push notifications out for any portfolio allocation changes? To be more specific, can there be an opt-in for the portfolio being tracked or monitored so we can tune for allocation changes based on the allocation changes from time to time? The way I understood this question is how I've answered it here. So there are multiple ways to make sure that you're tracking anything that you've either built or follow within the command module. So if you haven't already, and based on the last data set that we got from the development team, there is not more than probably a dozen or so advisors that have started using this. I do think it's probably still a fairly new tool that folks are using. You now have the ability to go into the model detail pages or from the portfolio toolkit and notify yourself to anything that's changing, whether that's an indicator change or an allocation change. So what I've got here on the screen for you to see is how you would do that just in the model detail page, because it's, in my opinion, the easiest way to find all of them. So right there, the first arrow that you follow, the SPL model detail. So when you're in the command module, on your left-hand sidebar menu, if you click model detail page, then you're going to arrive, obviously, here where you see everything. The second one down there is the pick models to follow. So you're going to go through. There isn't a select all or an unselect all option. We do want you to manually go through and pick which ones it is that you follow. And you'll go down and you'll click notify me, right? So if you click notify me, you're going to see that it turns into that gold color there. It'll be gray if it's not followed. Once you've selected that, anytime there's a change in allocation or an indicator that affects that model, you will get the email the night of that change. So if something changed tonight, for example, in buy and replace, then you would get that email after market closes, within sort of 3 or 4 hours, once everything's gone through and been verified by the research team. Then the email is going to come out and it's going to tell you that there's been a change to buy or replace, that you need to go to your model and look at the new allocations. If you scroll all the way down on that model detail page, and this is the final example there I've given you, scroll to the bottom of the page to find your custom blends and turn on notifications. So anything that you build in the portfolio toolkit, save as your name. So whether that's, Tom's Incredible Blend, or whether that's here's what I'm following, or whatever it is you've saved it as, once you've saved that blend, it's going to be on the model detail page at the very bottom. You can then notify yourself right there, or as you build it and save it in the portfolio toolkit, there's still going to be that notify me button right there. You can click that. And so anytime something that you've built changes, you'll get that notification, you'll get that email, you'll get that real-time signal to tell you that something has moved and shifted and that you need to now make a change. Okay, so I'm going to go ahead and look to see if anyone has questions. Okay, so I got a question here from, could you review the high yield indicator again, please? I am going to ask Tony if he can jump in and answer this question for us.
Yeah, I guess we'll have to go back on the slides. Is this the Intercontinental Exchange, Bank of America, the ICE, this one right here? So this is just strictly showing us the additional yield that investors are requiring to invest.
If I can just, Drew,
Yeah.
Drew says yes. Okay, I was going to unmute you, but just to confirm, Drew said yes, this is the one he wants to talk.
Okay, yeah. So this one is really just showing additional investors demanding additional yield to take on additional risk. So you can see there in early 2020 and with COVID that it just skyrocketed with the amount of fear in the market. So obviously, investors in junk bonds were demanding way higher yield versus the comparable investment in a T-bill or a T-note. So this is just a good way of monitoring whether credit markets are also really, as long as we're seeing lower risk in equities and credit markets, that's a pretty positive sign. When it gets nerve-wracking, is oftentimes you'll see credit markets start to show stress before equity markets. So that chart has the very end of 2018. If you remember, there was a pretty big sell-off in the fall of 2018, and credit markets actually picked up on that a little bit before, maybe a few weeks before the equity markets did. So it's just kind of again, kind of a CT scan of the entire market instead of a simple X-ray where we're looking at as many different areas of the market that might give us a little heads up on risk. So right now it's quiet.
Thank you, Tony. Next question we have is, are you considering a risk-managed crypto indicator? And again, Tony, I'm going to let you speak to that.
Yes, definitely. It would probably center around Bitcoin, just because that's the only one that really has enough price history for us to do any meaningful testing. And now IBIT's an ETF that's available through pretty much. I think it's even starting to be allowed in some 401ks and things like that. And I know that there's definitely interest among the pretty much. Now it's 40 and under crowd. So yes, that's definitely on our radar. We have some things that we need to shore up first, and that we're working on, that we're going to be excited to reveal as the time goes on. But yes, that's definitely on our radar.
Excellent. Thank you, Tony. I'm going to give it a few seconds here. If anyone does raise their hands to ask a question live or type it in, as I'm basically wrapping up. As a reminder, this is recorded, so if you want to rewatch this, go back and watch it again, then you will be able to find the webinar, as with all the other webinars, in the marketing tab of the command module. I'm not seeing anything else coming in here. I'm not seeing any hands being raised. So with that, we are going to end today's webinar. But again, thank you for joining us, and we will see you all in a month from now. Thank you all. Bye-bye.